What is this market-linked CD thing I've been hearing all about? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne. You've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about market-linked CDs. We're going to start off by talking about the characteristics of a regular CD that you would be familiar with at the bank. Talk about all the characteristics of that, so it's a starting point of comparison for us to branch off and talk about the similarities and differences in the characteristics of a what's called market-linked CD. By the way, you might also know these or heard them referred to as equity-linked CDs or index CDs. They're all referring to the same thing. And after we talk about the characteristics of a market-linked CD, then we'll talk about who they may or may not be appropriate for. I'll draw your attention once again to these like and subscribe buttons on the screen down below there, below the screen. Go ahead and click on those if you want to catch future episodes of The Vault with Doug, Garrett, and myself. Other than that, let's go ahead and dive into this, Garrett.
All right, Brice. So let's start with what people are probably most familiar with. Let's just go into the characteristics of a typical CD that's offered at your local credit union or kind of larger institutional bank.
Yeah, most people are familiar with these, but let's just go over the basics with them. They are FDIC insured, right? So $250,000 per CD, the federal government is going to back it for you. So if the bank were to go out of business,
you at least get your principal back.
At least get that $250,000 back. So we're familiar with that. The regular CD that you see at your typical bank has a defined time period, whether it's 6 month, 1 year, 3 year, 5 year. There's no surprises in how long it lasts. You know what you're going to get as far as the time frame of that CD.
Yep.
Okay. Another characteristic of a CD is it is not just a defined time frame, but is a defined interest rate that you're going to get. So regardless of what the markets do out there, regardless of how much the Fed is lowering or raising interest rates, you know what you're going to get for that 2, 3, or 5 year period in your CD. Right now, you can get a 6 month CD for somewhere between 4 and 5%. It's pretty typical. That might go down a year before too long. But again, no surprises, right? The time frame's no surprise, and what you're going to get as far as an interest rate is no surprise. Fees. Generally speaking, your bank would not charge you a fee.
Not a management fee, yeah.
A management fee or an entry fee to get into a CD under most cases. So there's no fees associated with a regular CD that you find at your bank. There are penalties for early withdrawal, so they are not liquid. So if you get a 5 year CD, you want to leave all that money in there for 5 years, because if you try taking any of it out, they're going to hit you with a penalty.
Yep.
So it's an investment that we consider illiquid. All right. They are not callable. So what do I mean by that? There are some investments out there that are callable, like certain bonds.
Yep, absolutely.
And they tell you that ahead of time, which means that if something were to change in the environment out there, whether interest rates or the market or inflation, something is changing that they weren't expecting, they have the right to end before that defined time period. Let's say it was a 5 year CD. They have the right to stop it at 3 years and pay you what you would have earned up to that.
Exactly.
Regular CDs don't have that. If it's a 5 year CD, they don't have the right to call on it in most cases. So let's keep our eyes on that, because we're going to talk about that in a few minutes with market-linked CDs. How are they taxed? How is the income tax? The interest is taxed as ordinary income on a regular CD.
Yep. It's 1099 income.
1099 income.
Yep.
So that's easy to understand there. And then the last one is there are no fees to be in it. So your bank doesn't charge you a fee to get into the CD.
Right.
There are fees for if you take your money out early, but there's no fee to get into it.
Okay.
All right. So there's our basic structure for a regular CD. That more or less defines what a regular CD is. I know we spend a lot of time, but now we can really easily understand what a market-linked CD is by understanding a regular CD.
Yeah. So most people are probably fairly familiar with, a normal, CD that's FDI insured that, their credit union may offer them. Let's talk about the characteristics of a market-linked CD and how those may differ from what they're used to at their credit union or their local bank.
Yeah, these have been around for, I'm guessing somewhere around 15, 20 years.
Okay.
So a lot of people are not overly familiar with them, particularly if you have an advisor and your advisor has not delved into the market-linked CD. You might never.
Relatively new instrument. Yep.
Relatively new instrument. And again, we talked about this before, and Garrett, the investment world, financial institutions find a way to fuse products together. For example, you can take a long-term care insurance product and they fused it together with an annuity, or they fused it together with a universal life. What they basically do is say, what person out there doesn't have the perfect investment for them based on their needs and desires and expectations? How do we put that type of investment together for that person or that group of people?
Right.
Fuse a couple things together. A market-linked CD is really kind of a fuse of a ETF and a CD, exchange-traded fund and a CD. So now that we understand what a regular CD is, let's talk about FDIC insured. Okay, just like a regular CD, most of your market-linked CDs are going to be FDIC.
A lot of them might.
There's some out there that aren't, but they're going to tell you if they are because they like to brag about that. So if it's issued by a bank, it's going to be FDIC insured.
Right.
So that's similar to a regular CD. There's also a defined period of time, just like a regular
CD.
1.5 years, 2 years, 3 years, 5 years. Those are the typical terms of durations that we see in the market-linked CDs. Now, here's where we take a big left turn.
Yeah, how does it make money, Brice?
What is that return for? So in a regular CD, we've got a defined interest rate. No surprises, right?
Yep.
Here's where that term market link comes into the market-linked CD. Your return is not a defined return. It is going to be based off of the performance of the market or an index, or maybe not an index, maybe even a stock or a selected group of stocks.
Yep.
Is what it tracks for that defined period of time. And if that index or group of indexes, it might track 3 different indexes and give you the average of those over that time period. If that grows, they're going to give you the growth based off of that. But there's something called a participation rate.
Yes.
Okay. So you want to be careful that you're looking at the participation rate on the CD. If you're tracking, say, the S&P 500, it might not give you a whole 100% participation rate of the S&P. It might only give you 50% participation rate.
Right.
Which means that if the market over that, let's call it a 2-year market-linked CD, and over the course of that 2 years, the S&P 500 went up 10%. Well, if you're tracking or participating in it only at 50%, that means your return would have been 5%. Right? So you can find ones that are tracking at 50 or participating at 50% or 100%. You'll even find some that are participating at more.
Yeah.
Than
like 120%.
Right. You might not find that on the really good indexes like the S&P 500, the powerful, the strong indexes, the reliable ones. But you could be tracking a stock, you could be tracking a lesser known index, and the participation rate is more than 100%. So that's how the return is defined. But you also need to keep in mind, besides the participation rate, the cap, so to speak.
Yeah.
Every market-linked CD is going to tell you over that 2-year period or whatever the duration is, what the maximum return is that you can get.
Yeah.
For example, I'll look at one right here that was issued last month by Bank of Montreal. It's tracking the S&P 500. The 10-year of the duration is 1.5 years. Its upside participation rate is 100% in the S&P 500, great. But the max return is 11.5%.
Right.
That means if the S&P 500 was up 20%, you got capped at 11.
11.5. Yep.
You can also look at it. What if the upside participation rate was 50% and the max return was 11.5?
Yep.
That means that the market could go up as much as 22%, and you'd get 23%, and you get the 11.5. If it grew up more than that, you were capped. All right. So those are some of the ways that are limiting or defining the growth potential on that. So again, might track you might find one that tracks 3 or 4 different stocks, and they might all be in the same field, or what's the word I'm looking for there? The same
like sector of the account.
Same sector.
Yep.
So you might find one that's got 3 or 4 technical stocks in there or something like that. I have one that tracks 3 indexes, but they're going to average the 3 out for you.
Well, Brice, I got a question that the audience might be asking themselves. What happens if I sign up for one of these 2-year market-linked CDs, but I want to take my money out early?
Okay, there's going to be fees for that, just like there was a regular
So
CD.
just like a typical CD, you got to hold it to duration.
Yep. So we'll talk about who these are appropriate for and who these aren't appropriate for in just a minute. But
Sure.
This is a good question that you want to ask, because that's going to be similar to a regular CD there. All right, now let's talk about fees for early withdrawal.
Yep.
There are, just like a regular CD. All right, we talked about that. What else did we talk about with a regular CD? They're not callable, right?
But these are.
These can
be.
They can be.
Yep.
Just like a bond, they might say that there is a call feature on this or not a call feature on it. If things were to change in the financial or the markets out there where interest rates changed and the issuer of the market-linked CD wasn't expecting that, and this CD is now overly competitive with everything else out there, they might not want that. So they might reserve the right to call it after a certain point in time. So if it was a 2-year market-linked CD, 1 year into it, and now interest rates have changed and what they're paying you is obscene compared to what the regular, the new issued CDs are, they might say, we reserve the right to call this and we'll pay you that.
For the first year.
The first year. So if you want one that absolutely cannot do that, you can filter your search or have your advisor filter the search where you're just looking at non-callable CDs.
Yeah, absolutely. It's possible.
So that's another feature of it. And then taxed. Same with the regular CD.
1099 income.
There you go. All right. Easy to understand. And the last thing is, are there fees involved with the advisor or whoever's?
Typically so.
Typically so. So let's say that you've got a relationship with a broker who every time he buys or sells a stock for you, he's charging you a fee.
A commission,
This is going to be the same with that. But you might have an advisor who is not charging you a buy and sell fee, but he's charging you an assets under management percentage. That typical one is 1%. So if he's managing $1 million for you, he's charging 1% on that $1 million, and you want some market-linked CDs, this would fall into the fee of that.
Right.
It just depends on what the relationship is with your advisor or whoever is selling it to you, under what realm do they operate.
Excellent. I think you've covered the characteristics.
There you go. They got the characteristics of a regular CD and now the characteristics of a market-linked CD.
So now that we understand a traditional CD and a market-linked CD and their characteristics, what type of investor might be appropriate for a market-linked CD? What type of investor are we looking at there, Brice?
Yeah, I think it would be very similar to a person who likes the idea of a regular CD. However, they're not content with a regular CD's interest rate returns.
They want a little bit more juice.
Potential, at least, a little more juice. They like the idea of participating in the market, but they want to take no or little risk. Now, I did say these are FDIC insured. There are some that have 0% loss exposure. Can't lose anything. But there are some that define the loss potential, 10%, 20%. So if the market, whatever market you're tracking, goes down more than that, you'll cap your losses on the bottom side. All right. So for somebody who likes the idea of being able to protect themselves entirely or to some degree on the downside, but is not content with the returns or the interest rate on a regular CD, they would rather participate in the market. They're bullish on the market, but they still know that they're locking away the money for a certain period of time.
Right.
That is who a market-linked CD would be appropriate for.
Okay. So I'm willing to have a certain portion of my money, kind of locked up for, a defined period of time. I want higher returns than, my average credit union can provide with a traditional CD. And I've got some hesitation on the risk exposure. So I want to have either principally protected notes or some amount of downside protection. That's what these market-linked CDs can provide.
Exactly who they're for.
Okay.
A good way of putting it. I have a conversation with the people who come in for our planning process frequently. They're sitting a lot of times on 100% liquidity.
Yeah, exactly.
They could take all of their money out and they would pay zero fees on it. Keep in mind, liquidity is like gold to a financial institution.
It is.
It has a value. And if you don't need it, you have the ability to trade in that liquidity to a certain degree and get something back for it. So if you've got $1 million in investments and you know that there is no way that you're going to spend more than $200,000 of that in 1 year, that means you have $800,000 that is right now is completely liquid that you don't need it to be. That means that you could put that money away for 2, 3, 4, 5 years and be benefiting from giving that liquidity to the institution. Keep that in mind. That is, a lot of people overlook the value of liquidity, that they're sitting on 100% of it and they never end up using it.
That's a great point, Brice. Did we cover everything for market-linked CDs?
That's a good, high-level introduction to what market-linked CDs are.
Excellent.
Ask your advisor about them. If you have an advisor and he's never brought it up, maybe he has those at his disposal. Maybe he doesn't, but it sounds interesting to you, then bring it up with your advisor or your broker. Other than that, I want to thank you for joining us. Again, the buttons down below there allow you to follow and subscribe to us so you can catch future episodes of The Vault with Doug, Garrett, and myself. And that's going to wrap it up for this episode of The Vault. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.